We're back and it's good to be here with you. So let's continue to the local reporting season theme and bring in our next guest. Michael Goldberg is joining us now from Collins Street Value Fund in Melbourne. Michael, welcome to the program. Hey, listen, congrats. I did see the Monday Fun Day piece in the AFR. I think the AFR has been watching ausbiz, if I can be so bold. But yeah, it was a good read. Talk to us about where we are sort of sitting currently in the markets. You know, we've had some negativity on US markets, but it certainly seems as if, the market, while it's, a little bit tired, it still continues to push higher.
Yeah, thanks, Nadine. Thanks for having me. I think the market's probably, or companies that make up the market, are probably as confused and facing the same sorts of issues that the government is facing and that consumers are facing. And I think about the current situation a little bit like trying to feed your child a chocolate bar to get him over to dinner time. So, we've obviously seen a lot of stimulus come through in the last few months. And we've also seen the government talk about other sorts of ways that they can stimulate the economy without paying out cash payments. But much like the child who you might give a chocolate bar to get them from lunch to dinner time, if you give them the right amount, that's great. If you give them too much, you could find yourself with a tangerine child and all sorts of problems when they've lost their appetite and come down from the sugar high. So I think probably what we've seen from the government, at least, was an appropriate and targeted stimulus package. I think what we're going to see coming forward is a moving away from those candy bars, from those cash payments, into more productivity incentives, things like tax discounts, things like removing red tape, all the sorts of things that Josh Frydenberg spoke about last week when he was going through the mini budget. And of course, for the ASX and for the list of companies that make up the ASX, the question is going to become, have they had too much stimulus? Have they seen their massive price increases and the wonderful rally we've seen in the market? Is that because we're hitting a sugar high? Or is it going to turn out to be that this was just something to get us through to the other side of things? And again, I think the answer is probably going to be different for different companies. I think you'll probably find that there are some companies that have taken this opportunity to strengthen their balance sheet, to focus their business model, to get rid of a lot of the waste and unnecessary parts of their businesses. And they're probably going to do quite well on the other side. I think, though, you're also going to find a lot of companies that are being referred to at the moment as zombie companies, where they're hyped up on the sugar right now, but when they come down, you could end up with the equivalent of a tangerine child, and some companies in some proper trouble.
Michael, are there any lessons you've been watching with the US earnings season that's been underway for quite a while now that can be transpired across to what's happening here locally?
To be honest, I don't really follow the US reporting season that closely, so I can't speak to it. I think in terms of what we're likely to see in the Australian market, I think we're probably going to see almost two separate markets. Obviously, the US market is much more driven by technology than we are, but in Australia, at least, we're mostly driven by commodities and the banking sector, really, and CSL. I think what you'll probably find is that reporting season for the likes of BHP, Rio Tinto, and Fortescue are going to be pretty positive. I think we saw some suggestions from Rio Tinto a week or two ago. They were near or breaking production records. So I think we'll probably see good results there, especially with iron ore prices being at $100 and change. I think companies like CSL tend to always do well. They just seem to be in the right sort of spot. They're a defensive company and people tend to like them because they are a good business and a defensive business. From our perspective, I think they're probably a little bit expensive for us to own, but I love the business for sure. And from the banks, I think what you're going to find is almost the opposite of what you're going to see from the commodity stocks. That they're not going to have earnings growth. They're not going to have dividend growth. They're probably going to have dividends coming back, and that's off the back of APRA's talk around Tier 1 capital and the banks as well being more conservative to protect that Tier 1 capital. I think to their credit, by the way, and I don't want to be too negative of the banks, what they've done over this period and what they've promised to continue to do has been incredibly socially responsible, and they should get kudos for that. But in terms of earnings growth or strong dividends from that sector, I think probably investors are going to have to get used to the fact that it's probably not going to be the case going forward for the next 6 months. And again, that's fair enough. We've had 6 months of COVID disruption. We're likely to have another 6 months of COVID disruption. Again, I think it's just one of those facts of life that investors need to be patient.
So, Michael, I'm presuming that the banks don't hold any great attraction to you, but I'm curious to know if you had a shopping list, a wish list heading into this reporting season, where do you think there might be some value thrown up?
Look, I think the challenge, as always, is that is that you've got to look away from the market as a whole. I think that's. I understand why people do it, because it's easy to say, oh, the market is up or the market is down, but the market is made up by 2,500 odd companies, and within that 2,500 companies, there are going to be companies that are going to do very well, and there are going to be companies that don't do so well. And I don't think you can say there's a specific sector that will do especially well or a specific sector that won't do especially well. I think you really need to be very much interested in the bottom-up analysis. You've got to find those businesses that have strengthened their balance sheets. You've got to find those businesses that have cut their costs, and you need to find those businesses that are going to not only survive but thrive on the other side of what we're going through at the moment. Perhaps infrastructure companies would do quite well, especially if the government does move towards stimulating the economy through infrastructure building projects. I think that would make sense. I think, like I said, the banks are probably going to have a bit of a tough time in the short term, especially given that they're giving mortgage holidays to a big part of their book. But again, Nadine, I'd love to give you a straight out, one size fits all answer, but there is no one size fits all answer. You've got to find the businesses that they're going to perform well, and I can't give you all of the secrets of our secret sauce.
No way, people are watching. Okay, but I'm curious, we're a new financial year, heading toward reporting season. Lots of people reflect, pause. What was sort of your big learning then from last year?
Yeah, look, I mean, I think it's always important to assess what's working and what's not working. And, to be blunt, the answer is always do more of what's working and do less of what's not working. Obviously, it's a bit more complicated than that, obviously. The example is, if you went to the casino and you put $100 on red and it won, you might, mistakenly think that, oh, red is how you make your money, whereas, of course, that's just outcome bias. It was a 50% chance. So you've got to work out what worked and what didn't work, but not just what worked and what didn't work, but why they worked and why they didn't work. Because sometimes you can do everything right, but not get the outcome you're after in the short to medium term. From a value investor perspective, that's okay because we take a longer term view. But for a lot of people who take a shorter term view, you need to work out not just whether you were right or wrong, or whether the share price moves in your favor or not, but whether or not you made the right decisions or not. I think from our perspective, probably the main learnings or the main themes from last year were maybe number one, debt. Recognize that debt is a double-edged sword. I've often said that if you don't understand something, you shouldn't use it. And I think that's certainly the case with debt. Although with debt, even if you do understand it, you probably still shouldn't use it. That would be my view. I think as well, we've seen that the drive, the envy drive, the fear of missing out drive is exceptionally strong. And obviously in the past, we've seen things like the dot-com boom and bust. We've seen cryptocurrency boom and bust. And I wonder if we're seeing some of that at the moment in the technology space and the buy now, pay later space. I'm not saying that's for sure the case. And certainly there are many good businesses that make up that industry. But number one, what's that industry worth? And number two, how do you pick the Google out of all of the other companies that might be jostling to get your attention? I think those are probably the two main points for us that really resonated. I think number one is the importance of patience. I think probably since 2008, 2009, we've been on such a massive bull rally that people haven't really had to have a tremendous amount of patience. Just the entire market's been going up. And so you could pretty much do anything and expect that your share prices were going to go up the next year and the year after that. I think what we're finding now, and I think it's a little bit reflected in some of the value investor fund managers and some of their returns over the last 6 months, I think what you're going to find now is that patience, it's not just a virtue, it could potentially be quite a profitable virtue. I had an old boss who once said to me, and it resonates as true, is that the stock market is a wonderful mechanism for transferring wealth from the impatient to the patient. And I think that's been true in the past, perhaps not so much in the last 5 to 10 years, but I think we'll see going forward that that's very much the case. And probably lastly, from our perspective, one of my analysts, Rob, often says, we've got to stick to our knitting. And I think that's 100% true, because you've got to focus on your core competencies, because when you don't, that's when the risk creeps in. Risk isn't some theoretical formula or some stroke of good or bad luck. Risk comes really from not knowing what you're doing. And again, like I said before, there are 2,500 odd companies out there. You don't need to invest in any of them, and you don't need to invest in any specific sector. So find the ones that you understand, and when the prices get right, that's when you should be investing. So again, stick to your knitting, have patience, be aware of the risks you're taking, especially when it comes to debt and leverage, and also just recognize that emotions play a big part in people's decision making, and don't get carried away in whatever the hot sector or hot stock might be, because it might be good now, but it might end in tears eventually.
Not bad advice for a rainy Monday morning here in Sydney. Michael Goldberg from Collins Street Value Fund, thank you so much for joining us here on Ausbiz today, and enjoy the rest of your day.
Thanks, Nadine. Thanks, Daniel.